So the first thing to do with Ashanti is to determine our group structure. And we could do this during our 15 minutes of preparation time. And we're told that Ashanti has 70% of Bochum, and Bochum has 80% of Ceram. And we're also told that on the 30th of April X5, that 70% investment becomes 60%, but that was on the last day of the year. So we're not going to give the NCI any extra profits or any fewer profits, because the deal took place on the last day of the year. Now, we're also told in note 2 that Bochum sold shares in Ceram. It sold 50%. So we went from having 80% to 30% for 6 months of the year, like so. So what we're going to have is an investment in Bochum for 12 months in which we have a direct investment of 70%, and for Ceram for the first 6 months it's 70% times 80%, so that's 56, and then for the next 6 months it's 70% of 30%, so that works out as 21. We give the NCI the balance. Remember, when we consolidate, we show 100% of the revenue and 100% of the assets of the subsidiary. So therefore we allocate that 100% between the group and the NCI. As far as our investment in Ceram is concerned, during the period it is an associate, the group controls 30% of the shares, but is only entitled to 21% of the profits, so the NCI have the other 9% of Ceram. So that's dealt with that particular information. So when it comes to allocating and doing our calculations in the income statement, I'm only going to consolidate Ceram for 6 months of the year. Now let's work our way through the question line by line. So for revenue, I've got 810 for the parent, 235 for Bochum. For Ceram, 6 months worth, which works out as 71. Cost of sales, 686 for the parent, 137 for Bochum, and for Ceram, 6 months is 42. Other income, the same principle, 31, 17, and 6. Distribution costs, 30, 21, and 13. Finance costs, admin costs, 55, 29, and 6. Finance costs, 8, 6, and 4. And the income tax expense, 21, 23, and 5. And there's marks available for this in the exam for identifying that Ceram was only a subsidiary for 6 months. Let's make sure we pick up those marks. I'd then leave a couple of lines, and in terms of OCI, for the investment, 20, 9 and 3. For the revaluation, 12, 6 and nothing. And for the pension, it's 14 negative. By having such an approach, you're accumulating marks all the time. Let's now take a look at the additional information. And we're told on the 1st of May X3, Ashanti acquired 70% of Bockham for 150 million. So we go to our goodwill calculation, which is going to be working number 3. And we'll have goodwill for Bockham and Serum. And a lot of this is going to be a standard goodwill calculation. So let's make sure we pick up the marks. In terms of the cost, that cost was 150. The fair value of the net assets was 160. So I go to my net assets working, and I'll say fair value was 160. The fair value of the NCI at that date was 54. So we go to our goodwill calculation, NCI at acquisition, 54. I'm going to go to my NCI calculation at acquisition, 54. The share capital and retained earnings of Bockham were 55 and 85 respectively. So we go to our net assets working, share capital, 55, reserves, 85. Other components of equity were 10. So OCE is 10. The excess of the net assets of the fair value is due to plant. So if I add these up, that comes to 150. So our fair value adjustment is the balancing figure, and that is 10, like so. Which is depreciated on the straight line method and has a 5-year remaining life. Well, how much depreciation is that going to be? It's going to be 2 million each year. So, because it's going to be 2 million each year, it's going to be 2 million in the income statement. Now, it doesn't tell us where to charge that depreciation. I'm going to charge it to admin and cost. You could charge it to cost of sales. It frankly doesn't make a lot of difference. I'm going to say here, depreciation, add 2 million, because that's 10 spread over 5 years. We can therefore, at this stage, calculate goodwill, can't we? I'm thinking all the time, this is a hard question. Let's pick up individual marks. He's given us the information because we've got the cost, we've got the NCI acquisition, and we're told the goodwill method. So let's the net assets at acquisition. That's 160. So goodwill for Bockham is 44. It then says Ashanti sold 10% of Bockham to the NCI. So this is going to be a new working. In terms of the sale of Bockham, The sale proceeds at that date were 34. So that's going to be debit cash 34. And let's think about what's happening with Bockham. With Bockham, our investment is going from 70% to 60%. So therefore we would be crediting the NCI at this date. And it says the carrying value of the NCI was 210 million before any adjustments on consolidation. So I'm going to go up to my net assets working. And the fair value of the net assets was 210 before any adjustments on consolidation. Well, we've got the fair value adjustment to put through. That fair value adjustment was 10 million. When did we acquire Bockham? May X3. It's now April X5. So can you see I'm going to charge 2 years extra depreciation at 2 a year. So that means we've got a figure of 216 for net assets. It says goodwill has been impairment tested annually and at the 30th of April X4 had been reduced in value by 15%. So the impairment at X4 is 15%. So that will have reduced goodwill by 6.6. And at the 30th of April X5 had lost a further 5% of the original value. So our impairment for X5 is 5%, which is a further 2.2. Now, the reason why we separate out those goodwill figures is that if there's been a goodwill impairment during the current year, that is charged to income statement. So that figure of 2.2, I'm going to go to my income statement. Now again, I'm going to charge this to admin, and I'll say goodwill. And if we are using the full method, remember the goodwill is split between the group and the NCI. So what I'm going to do, I'm going to put that goodwill impairment during the year through the Bockham column. Because when I calculate the NCI, it's already been adjusted for. It says the goodwill impairment should be allocated between the group and the NCI on the basis of the shareholding. So what we can now do, and here I'm going to take a slightly different approach to what I normally do for exam questions. I'm trying to sort out individual issues. So goodwill at the 30th of April X5 is 35.2. We can now work out the NCI's share of our gains and losses. So if we go down to the sale of Bockham, I'm going to credit the NCI their share of net assets. Well, what are we going to give them? What has been the increase in the NCI? The NCI has gone from 30% to 40%. So it's going to be, they've got an extra 10% of the net assets. The net assets at the disposal date, we calculated in working number 2, were 216. So that's 21.6. And we also have to give them an increased share of goodwill. And at the disposal date, goodwill is 35.2. So I'm going to say that that is a further 3.5. And therefore I'm going to credit equity 8.9. Okay. So that was a really nasty adjustment. But if there was 3 marks given for this adjustment, and you've done the basics, you'll have picked up 2. So even if you've just done sale proceeds and credited NCI with a figure, the chances are, well, we would say as markers, we can see the process you're trying to apply, we'll give you 2 out of 3. So even if you think the numbers are difficult, make sure you give it an attempt, because you will get marks for principle as well as accurate numbers. So that's note 1. We then move to Ceram. And it says that Bockham acquired 80% of Ceram on the 1st of May X3. The purchase consideration was 136. So into our goodwill calculation, I stick a figure of 136. The net assets had a fair value of 115. So I'm going to go here, net assets 115. And the NCI had a fair value of 26. So we can go to our goodwill calculation and stick in a figure of 26. On the 1st of November X4, we sold 50% of Ceram for 90 million. So we can work out here our gain on disposal. Oh yes, no, we need to put our... So I've forgotten that this is an indirect. It's 136, and the group share of that is 70%. So that's 95.2. The other 30% will be deducted from the share of the cost in Ceram in our NCI calculation. This would be the NCI calculation for the SFP, 30% times 136. So we would take away 40.8, like so. In November X4, we sold 50% of Ceram for 90 million. So we need to do a calculation for the sale of Ceram. The proceeds were 90 million. The net assets at that date were 160. We go to our net assets working. There were 160 at disposal date. We need to put that into our calculation here. So we've got proceeds plus the remaining investment plus the NCI less the net assets at disposal, which we've just been given by the examiner, The consolidated value of the NCI attributable to Bockham was 35 million at the date of disposal. So we'll say the NCI at the disposal date is 35 million. And the remaining shares are valued at 45. Bockham can still exert significant influence. No goodwill impairment occurs. So what we can therefore do is calculate goodwill at the date of disposal. We know that the NCI at acquisition was 26, and we are told that the net assets are 115. So we've got 95.2 plus 26 less 115. Goodwill is 6.2. So I'm going to take that goodwill figure of 6.2 and deduct it like so, and that gives us a gain on the sale of the subsidiary of 3.8. The NCI share of that would be 30%. Because remember, this is Bockham selling shares in Serum. So we're going to give the NCI, when we do our NCI calculation, 1.1, which is their 30%. But these are the type of things which people won't remember in the exam, and don't get stressed about it. Do the basics, pass the paper, forget about partial disposals for the rest of your life. What we could probably do at this stage is that we now know that given that profits arise equally over the year, we can work out a figure for the associate. Share of Serum profit. What were profits for the year? Serum's profits were 14. It was an associate for 6 months. And during that period, the group controlled 30% of the shares. So that gives us a figure of 2.1, but the NCI share is 30% of that. It's 0.6. Because remember, that represents 100% of the associate, and the NCI of Bockham have 30% of that investment, so we've got to give them 30% of those profits. Next, Ashanti sold inventories to Bockham and Serum in October X4. So this is before the disposal. So I'm going to go up to our profits here, and this is knowledge from F7. We've got sales of 10 and 5. So therefore we're going to reduce group revenue by 10 and 5. And we're going to increase group cost of sales by 10 and 5. Ashanti sells goods at a gross margin of 20%. At the year end, half of the inventory sold to Bockham remained, but the entire inventory sold to Serum had been sold on. So therefore we don't need to do an adjustment for that. Our inventory profit adjustment is a gross margin 20% on sales of 10 million. Half of them remain. So that works out as a reduction in inventories and an increase in cost of sales of 1 million. The next item has got nothing to do with consolidation. It's testing us on financial instruments. So we say in respect of working number 9, this is our bond. And we've got the cost of the bond, and here we're using the amortized cost model. So in terms of the date, we bought the bond on the 1st of May X2. It then tells us, this is a little bit confusing, it gives us the value on the 1st of May X4, which is the start of our year. So that 21.60 wasn't really a lot of help. We've got a figure here of 21.046. Interest is 4% every 6 months. So in terms of our income statement interest, I've got 21.046 times 4%. So that's, I'm going to say, 2 decimal places, 0.84. In terms of cash, it says the issuer of the bond did pay the interest. The nominal rate of the interest is 5% on a bond of 20 million. So we will have received cash of 1 million, which gives us a carry forward figure. And this is going to be at the 30th of the 10th X4. So after 6 months, 21.046 plus 0.84 less 1. 20.886. So we've got 20.886. We then work out interest on that at 4%. Again, that's another 0.84. Take away the cash of 1. So that gives us a figure of 20.726 at the end of the year. And we are then told that we have an impairment. The impairment value is the present value of the cash flows. So we've got a cash flow being expected of 2.34 million in 1 year. So therefore you discount it, and you always discount it at the original rate of interest. So I'm going to discount 2.34 for 8%, and then a further 8 million at 8% for 2 years. That gives us a figure of 9.03. Therefore, the impairment is going to be the value in the balance sheet, and I'm just going to put this to 2 decimal places just to make my life easier. 20.73 less 9.03. Which works out as 11.7, and that will be debit the income statement and credit the value of the bond. So our impairment cost is 11.7. How you want to treat that is down to you. I might put that through, as it's an impairment of a financial asset, I might add that to finance costs, or I might put it through against admin. Frankly, nobody really cares. I'm going to go up to the income statement. Finance costs. Bond impairment 11.7. And that bond impairment has come from working number 9. It says no accounting entries have been made in the financial statements for the above bond since the 30th of April X4. So what we also have to deal with is the interest. So I'm going to pick up the interest expense from working number 9. And remember that the interest is being charged twice a year. So it's 0.84 plus 0.84. That gives me a grand total of 1.68. I'm going to keep things to one decimal place in my income statement, so I'm going to round that up to 1.7. I'm trying to have a logical flow through. It's nothing to do with groups, this is a completely independent issue. It's classic P2. You'll pick up a P2 topic and allocate it to this section of the exam. Note 5. Ashanti sold $5 million worth of goods to a customer who made an announcement. It's going to restructure its debts. It's probable Ashanti will not recover the amounts outstanding. The goods were sold after the announcement was made, although the order was placed prior. Ashanti wishes to make an additional allowance of 8 million. I'm thinking, what on earth is going on here? Well, we should not have recognised the sale, because we should only recognise sales if receipt is probable. So what I would say here is that Ashanti should not have sold, or should not have treated the $5 million sale as revenue because it was not probable that it would have received cash from the customer. So therefore I would debit sales or revenue 5 and credit receivables 5. Ashanti wishes to make an additional allowance of 8 million against the total receivable balance at the year end, of which 5 million relates to this sale. So an additional 3 million should be treated or should be charged to the income statement as a bad debt. So therefore I would debit the income statement 3 million. Perhaps you would charge that, perhaps I'm going to charge that to admin costs, and credit receivables with that further 3 million. So I go up here. and sale from working 10. I'm going to reduce sales by 5 million. And then go to admin costs. Bad debt from working number 10 is a further 3 million in respect of Ashanti. Some really unpleasant tweaks here. Don't get stressed or de-stressed by them. Then note 7. So we're on to working number 11. Here we're looking at holiday pay, and I've missed out working number 6. No, number 6. Good grief, this question is huge. We've got something to do with PPE. The cost is 12 million. It was being depreciated over 10 years, and it was revalued 1 year later. So the cost was on the 1st of the 5th X3. We would charge depreciation. 1 year's depreciation is 1.2, which takes us down to a figure of 10.8 at the 30th of the 4th X4. And at that date, we revalue to 13 million. So therefore we have a revaluation surplus is 2.2. We would then charge depreciation, again 1 year's depreciation. How much is this going to be? 13 million spread over 9 years. So 13 divided by 9 gives us a figure of 1.4 to deduct. So our carrying amount at the year end is 11.6. We impair the asset to 8 million. So therefore I'm going to credit PPE 3.6 million. I'm not going to put through all of that impairment against the income statement, and the reason for this is that we've got a revaluation reserve. Remember, we've got a revaluation surplus of 2.2. So I'm going to debit the revaluation surplus, which is effectively OCI. But remember, we would have also have made a transfer out of OCI, or out of the revaluation surplus, into retained earnings. So the depreciation would have been 1.4. The transfer would have been 2.2 spread over 9 years. So let's say to the nearest 100,000, that's 0.2. So our revaluation surplus is 2.0. Remember, each year you go debit revaluation surplus, credit retained earnings, with the revaluation surplus spread over, and our depreciation charge has gone up by 0.2, so it's the extra depreciation that we make the transfer for. And that's an F7 issue. So I debit the revaluation surplus, the remaining figure of 2.0, and we debit the income statement 1.6, which is our impairment. So I'm going to take that 1.6 impairment and I'm going to charge that to the income statement admin costs, impair 1.6, and that's come from working number 11. Now remember, if this was a real exam, you wouldn't have even reached this stage because you'd have used up the full 35 minutes worth of time. One more adjustment to make. This is in respect of holiday pay, and we should strictly work out an accrual for holiday pay. The best way of saying it, it's not entirely accurate, but we've got 900 employees, of whom 5% we think are going to leave. They are carrying forward 3 days holiday pay out of a grand total of 255 working days, and the salary cost is 19 million. So that works out as 0.2 million debit income statement, credit accruals. You would then take that up to the income statement. You could charge it against admin or cost of sales, wherever you want to charge it. It really doesn't make a huge amount of difference. And then you can start to work out some totals.